Mahesh Nandurkar, who's India strategist at CLSA, joins in with his take on the markets. Mahesh, it's great to have you on the show. Thanks very much for taking out the time. How are FIIs viewing India? You also have been overweight on India for a while now. Give us your sense.
The foreign investors, over the last 12 to 18 months have actually been reducing their India weighting. We have seen money moving out of India and getting into the other markets like China and Korea, where we are seeing greater earnings momentum. We've also seen globally the trade, or the style has moved to more value. And obviously India is not really a value market, and which has worked against India on a relative basis. But what I will say is that at this point in time the interest seems to be coming back into India once again. One of the primary reasons I would say is growth is showing signs of bottoming out, and we've also seen some of the important measures like the bank recap, which has been one of the key concerns for a variety of foreign investors.
Now, NPA is one of the black holes in the economy. How are FIs looking at that?
The earnings season for the September quarter, I would say so far has broadly been in line with expectations. We haven't really seen much of earnings upgrades, on a net basis as yet. I mean, there have been some stocks where we have seen upgrades, but there have been some other stocks where we have seen downgrades as well. So on a net basis, we haven't really seen the kind of EPS upgrades that would really attract the foreign investors just as yet. But I'm quite hopeful that going forward, into the next 3 quarters, because of the low base, the YOY comparison is going to look quite comfortable, and the YOY earnings growth will look quite attractive. But I think key for the foreign investors would still be whether the companies are able to beat estimates, or not. My sense is that at least the EPS revisions on the downside have kind of bottomed out. But I don't think we are in the phase where the earnings revisions are happening on the upside, just as yet. And as and when that happens, then we'll probably see much greater inflow from the foreign investors. But in the meantime, at least the outflows should definitely stop, in my view.
Mahesh, India's profit to GDP ratio is still low or bottomed out. Is there something else to watch out for?
True, you're absolutely bang on. The corporate profit to GDP ratio, which was as high as 7% of GDP back in 2007-8, has now come down to almost 3%. So it's a pretty big deceleration, on that front. We have already seen signs of that bottoming out. For this year, for example, which is FY18, we're looking at the corporate earnings growth of in the range of 13 to 14%, which is slightly higher than the nominal GDP growth. Next year, we're looking at close to 20%. So the corporate profit ratio to GDP is definitely going to be improving from here on. So the focus will clearly be, on the sectors which will take this ratio up from where it is right now.
Right, Mahesh, which sectors will outperform the market, you think? Because, a large part of the outperformance is already done. What goes up from here?
So one of the themes that we have been very, very positive on for some time now is the housing construction segment. What we say is that over the last 5 years, the housing market has not really done anything, both in volume terms and in value terms. The market has just stayed flat, and we feel that the housing sector is now at the tipping point, and the improvement should be likely going forward because of 2 factors. The primary factor is the housing affordability measured as the ratio of household income, the mortgage payments to household income, that has gone down to an all-time low, and also the government efforts to kickstart the housing sector. So both put together makes us very bullish, and so that obviously has the positive impact on a whole host of sectors. Housing finance is the obvious one. Then apart from that, you have building materials like cement, and also the non-cement building material segment like the construction pipe segment, etc. The household durable segment, which is something that will plow back onto the housing demand, and obviously the developers themselves. So this whole host of the housing related plays is something that we are quite positive on. The second theme that we like quite a lot is the NPL cycle we feel has peaked out, and the government recap initiatives is only going to accelerate the NPL resolution. So the corporate oriented banks, both on the private side and some of the leading public sector banks, would be quite good on the back of that theme. So these are the two sort of big themes that we like. Apart from that, some of the other sectors that we like include the industrial segment. We have kind of also turned now neutral on the healthcare side as well. We were running underweight position on that for some time. That we have turned neutral. The space where we would still be underweight definitely is some of the more expensive segments in the market. One of that is clearly consumer staples. So I would say we would basically be positioning on the sectors on that front.
So considering all the structural reforms that government has floated, do you prefer private banks, or now it's time to relook those PSU banks?
So as I said, I would not just make a distinction between public and private. I would make a distinction between the corporate banks, and the non-corporate banks. So clearly our preference is for corporate banks. So there are certain banks within the private space, as well, who will benefit from the NPL resolution cycle. So we would like those, as well. And as far as the public sector banks are concerned, I would still play with the top tier banks on the public sector side, because with the details as to which bank is going to get how much and what the criteria would be, it's still not known. So I would still say best to play with the top tier public sector banks.
Right. Mahesh, you're bearish on consumer staples in spite of GST and now the rate revisions as well. Why is that?
True, you're absolutely right. It's not that we feel that the consumer staples sector is going to see like earnings degrowth or something, but I think the sort of equation between valuation and growth doesn't seem to be quite attractive for the staples space. So we're looking at about 15 to 18% kind of earnings growth for most of the names in the staples sector, whereas the valuation multiple is somewhere between 35 times to 50 times. I can find many other consumer stocks, mostly on the discretionary side, which will have lower multiples than this and higher growth expectations. So I would rather much go with consumer discretionary side, which will be some of the auto names, some of the food services, or some of the other names that I mentioned, which are linked to the housing space. So those I feel will give me better growth at lesser multiples. So I would prefer these over the expensive consumer staples.
Mahesh, do you think pharma stocks are overstretched, and the US FDA is very proactive right now? I mean, how would you position yourself in pharma? Is the relationship improving and thereby there is an opportunity to buy pharma?
True. No, I actually meant the pharmaceuticals, only because that is one segment where we were quite underweight earlier, and I feel that we have seen significant correction in some of the stock names over there. Yes, I agree that some of the correction in the stock price is also associated with the earnings disappointments as well. So PE multiples haven't really come down as much as what it would appear. But still, on the risk reward basis, some of the select pharma names, do look attractive.
Right, so have to talk about IT, some sporadic bounces up coming in, but how are you approaching the sector? Are you liking it fundamentally?
I feel that IT sector will at best be a short-term trade in my view, because the valuations are low, and some investors may get attracted towards that sort of an aspect. But if I look at the sector from a 3-year or a 5-year view, I feel that the growth is going to be mostly in high single digits, maybe 10-12% at best, but mostly in high single digits. So this is not a sector that I will buy and hold forever. So maybe for a short-term trade, one could look at it, but on a structural basis, this is the other sector that we would still continue to underweight.
So which one do you prefer, large cap IT or mid cap IT?
Well, I won't really classify the stocks just on the basis of large cap versus mid cap, because I think it will be too generalized kind of a discussion. But just to come back to my original thing, I mean, there are certain themes, as I mentioned, that we like. Like when I said the housing as a theme, so there are like many mid caps and small caps as well, which we think will do well, on the back of that theme. So wouldn't really classify, one way or the other. Also, we need to keep in mind, the recent, regulation or a thought paper that the SEBI has come out with in terms of the mutual fund ownership, and the classification of what percentage of when the holding has to be in what kind of segment, whether large cap, mid cap. We still need to see some more clarification on that. It's a technical factor, but we still need to keep that in mind. We don't really have enough information on that at this point in time. But just to repeat, I think large cap versus small cap is just too generalized, a comparison in my view.
Okay, Mahesh, great speaking with you. Thanks so much for candidly talking about all the sectors where you do have interest and where you think, investment should get ebbed off.